Hi, my name is Z and I'm an options trader. I've been growing my portfolio by 25 to 50% year over year with options. And today I want to show you guys how options work with live examples in my account. We're going to be buying and selling calls and puts. We're going to take a look at my account balance to see what happens when you buy or sell these contracts, how the money is made, and also take a look at assignment. It's extremely important to understand the basic mechanics of options before you start trading them and see how you can make money or lose money. So what are stock options? Stock options are contracts that give an investor the right but not the obligation to buy or sell a stock at an agreed upon price and date. So the most common ones are calls and puts, where calls are the right to buy an asset at a stated price within a specified time frame, and puts are the right to sell an asset at the stated price within a specific time frame. So let's go into my platform and buy some calls and puts. So here you're looking at my margin account. I am using Thinkorswim, which is a trading platform, and I pulled up the option chain for SPY, which is the S&P 500 ETF. The options chain basically describe all the price is the market. It describes all the prices for all options at all strikes for all expirations. So for example, if I wanted to look at the pricing for options that expire today in less than 2 hours, I can open up this tab right here and I can see all the options pricing, the call option pricing on the left and the put option pricing on the right. So what you're looking at here is the market for, say, a 544 call option. It is currently 32 by 33 cents, which means that somebody's willing to buy that option for 31 cents, and somebody's willing to sell that option for 32 cents, 33 cents. So as you see, calls are a way to speculate that the price of SPY is going to go up, and when SPY goes up, the price of these options will go up a little bit as well. So let's buy a call option, and so here we see that we're putting in a limit order. So there's kind of two different types of orders that you can use for this. You can use a market order, which just basically means give me what somebody's willing to sell this asset at to me, or this contract at to me, or a limit order, which says I am willing to pay this much or less for an option. A limit order is the most common way to put in an options trade because you don't want to let the market maker trick you by taking what's at market. So I'm going to put it at $35 limit. So this is 35 cents, but whenever we buy a contract, it's actually 100 shares of SPY that it represents. So we take this amount and we multiply it by 100. So we're going to confirm. This is going to cost me $34 plus 40 cents, which is the commission for this particular trade. So it's going to cost me $34.40. I'm going to So that order actually filled at $32. And if I look at my account statement, I'm just going to refresh it real quick. You'll see that my account has been decreased by $32.40. And here you can see kind of, that position going up or down. It seems like SPY has gone down just a little bit since we talked. So I'm down a couple dollars on this position. You can do the same on the put side, and as the market goes down, you'll see that the pricing for the puts is going up. I'm not going to buy it, but it's basically the same mechanic, and it will reflect the same in your account. Okay, great. So now we bought this option. How do we make money from this option? Well, the first way you make money from this option is by selling it. So you can say, okay, I'm going to sell this option, and hopefully the market's going to come up just a little bit for us and maybe give us a profit. So we're going to sell this option at 34 cents. So remember that we bought it at 32 cents. Now we can sell it at 35 cents. So we can be making $3 on this transaction. So we're going to, kind of sell it right now. Come on. And there we go. So we just sold I'm gonna refresh that right here. So we bought it for $32 and now we're selling for $35. So you'll see that my account has increased by a little over $2 after commissions. Great. So another thing we can do, instead of flipping the shares, is actually exercising the shares, and exercising our right to buy the underlying at a particular price. So I'm going to go into a slightly bigger account and demonstrate this on a smaller priced option contract. Sorry, smaller price underlying to kind of demonstrate this. So Ford is currently priced at $10 right now, and say I buy an option for $9. So we're just gonna buy this right now. This is gonna cost me $121. Great. So now you'll see that I have this Ford position right here. And so I can flip this option right now and sell it for $120. But what the other thing I can do is I can exercise my right to here. I can exercise my right to buy the stock at $9. So we're going to try doing that. I'm going to put in an order to do that. And this generally takes a little bit of time. This means that it's going through review, and give it a couple seconds. What it will do is actually go into waiting. What happens is the options commission. So now it's working, which means that somebody is looking for a counterparty to fill this order. And this should fill reasonably quickly because a lot of people do have exposure to Ford and will fill me at this particular price. So give it a second, and there it goes. So if you look at my account statement, okay, great. So I bought this option for $121 right here, and I sold that contract, but it allowed me to buy 100 shares of Ford at $9. So that's $900 here. And now you'll see that I have 100 shares of Ford in my account. And what I can do is I can go around. I can then, you can wait. If you're a long-term bull, you can kind of hold on to this for as long as you want now. But what I'm going to do is I'm actually going to sell this at $10.19. So if you look at my account statement, you'll see that I sold 100 shares of Ford at $10.19. And overall, I've basically lost like $2 and a little bit more in commissions as part of this trade. So this is showing that you can actually exercise the contract as well. Most brokers will exercise this contract for you if contracts for you if it is in the money. So what we're actually going to do is we're going to actually buy this contract and hold it through expiration. It's very unlikely that Ford's going to drop, over $1 more than 10% in the next 2 days. So what I want to do is show what it actually looks like when the broker automatically exercises a call for you. So we're just going to buy this, and we are going to take a look at this in 2 days. So in the meanwhile, one thing that we can do is we can actually sell options as well. So let's go back to SPY. So in order to open a position, we don't have to buy to open a position. We can be an option seller. What does this mean? We are willing to give somebody else the right but not the obligation to buy an asset at a certain price, and we take on the risk of that asset going higher if it's on the call side or going lower on the put side. So what does this mean? So say I speculate that SPY is not going to be above 544 by expiration, which is an hour and a half. What we can do is we can actually sell that option for $40. Now what this will do is this will credit my account by $40, but somebody else is now the buyer on the other side, and they can exercise the call at any point in time, like how I exercised the 4 call option. And when they do, I will be short. I will sell 100 shares of SPY to the holder of the option. What does that mean? That means I am going to be short 100 shares of SPY. Now that if you're a short stock, you can actually have unlimited risk, and this is okay in certain accounts, but not all accounts. So for example, in this particular account, I have a I have a margin account, so I can be short naked shares. However, other cash accounts such as IRA accounts does not allow you to do so, and they don't let you short contracts like this. So if I try to sell this contract, it says it's legal. And what this means is that I cannot take unlimited risk in this account. Well, how do I cap the risk in this account? I will have to buy a call option at a higher price, which says, okay, well, if the cost of the shares will go up by a certain amount, I actually have a contract myself that I can exercise and be able to buy shares of SPY at a particular price from somebody else and fulfill my short obligation. So let's actually take a look at how this works. And so here I am going to short the 5. We can do the 544 again. That's totally fine. Hopefully the market doesn't move against me during this trade, because I do have, like I mentioned before, unlimited risk. So I'm going to do that right now. Great, I sold it for $40. And you see that my account is actually credited by $40. So I used to have $264, now I have $233. And if I were to hold this into expiration, I would be short stock. In fact, we will actually show this happening on a stock that is a little bit more less likely to move a lot. Actually, so we can do actually this right here. So I'm going to short Ford in another account. I'm going to short maybe this right here. So I'm going to make a bet that Ford is not going to finish the week higher than $10. I'm going to be credited $23 for that bet. This is going to take up $200 in my margin account because I have a portfolio margin account, and the broker is willing to lend me money in order to fulfill my obligation. So it only takes me $200 of buying power. And for protection, I'm actually going to buy a contract right here to cap my risk, so that at maximum I will lose $50 on this trade, or I will only lose $27 on this trade because I was given $23, but I have $50 of risk because this is a 50-cent wide debit vertical. Put vertical. So I'm gonna just do this real quick. And in 2 days, we'll see how, if I get automatically exercised here, what that looks like in my account. All right, a couple of days have passed, and let's see what happened after the expiration date has passed for the call option and the sold call option. So you'll see here, this is the account where we bought the call option, and on Friday at closing, what happened was I was able to exercise my right to buy 100 shares of Ford at $9, so that debited my account by $900. And later on Monday, I was able to sell that for $10.50. So actually, in this transaction, I was able to make $150, but the cost of the option was about $120, so I only made about $30 in that particular trade. In my other account, I sold a call option for at a strike price of $10. So when that automatically got exercised at the closing on Friday, Ford was trading at 10.50ish. So it was well in the money, and the counterparty exercised their obligation, right but not obligation, to buy Ford at $10 as opposed to whatever Ford was trading at. So you see that they bought it. My account was credited $1,000 because I sold 100 shares of Ford at $10. I actually, on that day, I knew that this was going to happen, so I actually bought 100 shares of Ford so that it could be sold to the counterparty, and I bought it at $10.45. I didn't want to be short, 100 shares of Ford over a long weekend. Anything can happen, so I just kind of capped my risk off. So in this, I lost about $45, but at the beginning of the trade, I sold the call, and that credited me my account for $23. So I only lost about 20 some dollars on this trade. As a bonus, there's two kinds of assignment. There is stock assignment and there's cash assignment. So I was trading XSP, which is a product that is 10 times smaller than the SPX, the most liquid product in the world. It's S&P 500 index. That is a cash settled product. So I bought a call vertical, which is really just a long call at 553 and a short call at 555. And when it exercised, you see that it resolved the difference between the actual price of XXP, which is apparently 2.43 more than 553. So it was in the money. So I credited my account by 243. And on the short call side, I was assigned $43. So the net of that was about $200 worth of credit into my account. I paid about $150 on that trade, so I made $50 on that. It was actually a roll from an existing trade with even less debit, so I made a small profit on that trade. But you see that I did not have to buy or sell stock in order to book this profit. It automatically just kind of calculated it in my account at the end of the day. So if you like this kind of content, it's extremely important to understand what money is going in and out of your account and for what reason. Especially on the assignment side, it can get very tricky. If you like this content, please like and subscribe, and I will see you in another video.